Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the sometimes crazy world of corporate finance. And today we have a doozy of a report from PANGAEA Logistics Solutions. LTD, get ready because we are about to dive into the 30th of September 2025 filing, and it looks like their business is on the move, literally. So what exactly is PANGAEA Logistics Solutions Ltd? They are in the business of shipping dry bulk cargoes all around the world using their own and chartered ships. Think of them as the trucking company of the oceans for things like coal, iron ore, grains, and other raw materials. Let us jump right into the numbers. Looking at their balance sheet for the 30th of September 2025, we see their total assets are about $932 million. While at the 31st of December 2024, it was just a bit higher at $936 million. It seems like things are holding pretty steady. You also see current assets at over $212 million, an increase from $191 million at the end of last year. This is a good sign showing they have more quick assets. Accounts receivable is around $45 million. Now here is something interesting. A note says one customer accounts for 34% of their receivables on the 30th of September 2025. That is a big chunk from a single client. For a company this size, relying so heavily on one customer can be both a strength if that customer is stable, but also a risk if they decide to pool their business. Their fixed assets are a major part of their business, worth over $683 million. This is where the ships live. But it is interesting to see a decrease from $707 million at the end of 2024. They are in the process of selling one of their vessels, the MV Bulk Freedom, as noted later in the report, for about $9.6 million, expecting a gain of $2.8 million. This is a smart move to optimize their fleet and possibly free up some cash. Shareholders' equity stands at about $465 million, down from $474 million at the end of last year. This is mainly due to share repurchases and dividends paid out. They returned about $13 million in dividends and spent about $2 million on repurchasing shares this past quarter. Now let's look at how they have been performing financially. For the 3 months ending the 30th of September 2025, total revenue was about $168.7 million, up from $153.1 million in the same period last year. That is a solid 10% increase. Voyage revenue, the bread and butter of their business, grew by 7% to $155.3 million. This is mostly thanks to an 18% jump in voyage days. They are simply shipping more cargo. Charter revenue saw a massive jump of 91%, going from $4.9 million to $9.3 million. This is mostly because they increased their time charter days significantly from 256 days to 495 days. It looks like they are making more money by renting out their ships for specific periods. Expenses are also up as expected, especially vessel operating expenses, which jumped 57% to $21.7 million. This makes sense because they have more ships now. The cost per Dalton Y, though, excluding technical management fees, only went up slightly, indicating good cost control on their own ships. General and administrative costs increased by a pretty significant 64% to $9.9 million. A big chunk of this increase is due to consolidating CMAR management into their financials and higher employee incentive costs. It seems they are investing more in growing the company and managing all these operations. All of this has led to a much healthier net income. For the 3 months ending the 30th of September 2025, their net income attributable to shareholders was $12.2 million, up a considerable amount from $5.1 million in the same period last year. That is more than double, and that translates to earnings per S-Hair of $0.19, a big leap from $0.11 last year. For the 9 months of the year, their earnings per S-Hair stand at $0.12 compared to $0.45 last year. This shows that, while the third quarter was strong, the year-to-date performance is down from the previous year. This is likely due to some of the market headwinds faced earlier in the year. Looking at their cash flow for the first 9 months of the year, operating activities provided about $38.6 million. This is down from $46.4 million last year. The decrease is mainly due to lower net income and higher dry docking costs. Dry docking is basically getting their ships serviced and ready for the next few years. It is a necessary and often expensive part of the shipping business. Investing activities show a positive cash flow of $1.9 million for the first 9 months of 2025. This is a huge turnaround from last year when they used $57.4 million. This difference is mainly because they spent a lot of money buying ships last year, and this year they sold one. Financing activities show they used about $33 million this year compared to getting about $5 million last year. This change is largely because they received a large amount, $64 million, from debt in the prior year, which they did not have this year. They also made some larger debt payments and received less from financing obligations compared to last year. Now let's talk about adjusted EBITDA, a measure that companies often use to show their operating performance excluding certain items. For the third quarter of 2025, it was $28.9 million, up from $24 million in the same period last year. This shows their core business is improving. However, for the 9-month period, it was $59.3 million, down slightly from $60 million last year. This mirrors the net income trend, where the third quarter was particularly strong. Looking at their segments, their shipping segment is clearly the main event. Total revenue for the shipping segment grew by 10% for the quarter. The real star here is TCE revenue, which is like their net revenue per Dalton Y. It was $15,559 for the third quarter of 2025, down from $16,324 last year. While the rates went down slightly, the company outperformed the market average by about 10%. This difference is likely due to their long-term contracts and their specialized fleet, which allows them to command better rates or secure more consistent business. Geographically, the United States remains their biggest market, contributing $43.4 million in revenue for the quarter, followed by Canada and Singapore. Singapore, in particular, saw a massive revenue jump from $1.6 million to $13 million, showing significant growth in that region. Looking ahead, the company is already making moves. They recently agreed to sell the Menvi Bulk Freedom, another step in optimizing their fleet. They have also declared a dividend of $0.05 per share. Now, for my take on all of this, PANGAEA Logistics Solutions Ltd is navigating a tough industry, but they seem to be doing a decent job. Their third quarter results are very encouraging, showing growth in revenue and net income. The jump in charter revenue and strong TCE performance suggests they are managing their fleet effectively and capitalizing on market opportunities. However, there are some areas to watch closely. That significant customer concentration remains a risk, and the slight dip in year-to-date performance compared to last year indicates they are not immune to market downturns. Also, their increasing general and administrative expenses need to be monitored to ensure they do not outpace revenue growth. On the positive side, their continued fleet optimization and disciplined cost management are strengths. They have a good amount of cash on hand and are focused on generating value for shareholders through dividends and buybacks. Overall, PANGAEA Logistics Solutions Ltd appears to be on a path of operational improvement and strategic fleet management. While the shipping industry is always a bit of a roller coaster, they seem to be steering the ship reasonably well. Let me know what you think about their performance and what their future holds in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into corporate filings just like this one. And make sure you join our Discord community linked in the description for more discussions and insights. Thanks for watching, and I'll see you on the next one.